Lots of things going on. Obviously, not all of them very positive recently, but still a reasonably good outlook for this year from a profit standpoint. If you think it's going to be anything like last year, you're badly mistaken. So we'll go through kind of the factors that I think are driving this and the factors that I think are going to come to play here and where I think they're going to be. Still, the biggest thing, the most important thing in our business at this point is this fundamental shift in grain and oilseed supply and demand. We're through the biofuels growth years. Now, that don't mean they're going away, but we've caught up with them. And as we've caught up with them, we've pushed these prices back to more reasonable levels from a cost standpoint. You're not going back to where you used to be on any of these feed ingredients, but we're sure not going to be staying where we were in 2010, 11, and 12 either. And so that's an important thing for the long term. World and domestic economic growth are improving in most cases. We've got some things going on in parts of the world that are not very solid, but there are some places that are certainly improving. I think that's good for us. We've had a big change in U.S. consumers, and especially in their viewpoint of animal fats and protein in the diet. We'll talk kind of extensively about that and its impact. We got expansion everywhere. With those lower costs come lots of incentives to expand. And so you've got the chicken business that is finally kind of getting lined out and expanding as we speak. Of course, hogs overcoming PEDV and the growth that we saw in the December USDA Pig Report. The cattle business is in the process of expanding, but as we know, that takes a very, very long time. And so even though they're expanding their production capacity right now, we're not going to see any results of that for some time to come, which is a good thing for us because beef prices are going to stay high. The risks are numerous. There are lots of risks out there. That's probably something I could put that slide in everything that I've done, every presentation I've done over the last 10 years. You know that as well as I do. And so let's get started. First, the corn supply situation is vastly improved. The left-hand chart here is world supply and demand of corn. The important line on that chart is the bottom one. That's reserves, and we can see that projected year-end stocks are the highest they've been in 15 years. So we've kind of taken the blow from the demand side of all this corn going toward biofuels. We've responded to it with acres and with technology and with yield growth. And now we're finally building up some stocks here at the end of the year that should keep these prices at a more reasonable level. On the right side is non-U.S. corn production, which has increased by 50% since 2004. Amazing. When you drive up the price of something, you attract competition. There are people who say, I'll get in that business too. And there have been quite a few acres of that in other parts of the world. And some notable growth in the southern hemisphere, which provides us a bit of a counterbalance, just as their soybean crop has done over the years. So an important development, I think, that with some lasting consequences there. The bottom line is more stability at a lower price level than what we've seen. I think we're going to see a lot of corn between 3.5 and 4.5, maybe 3.25 and 4.25 a bushel over the next decade. The exception to that is going to be the year when we have a real drought. Okay, it's 24 years between the last two of those. I don't think it'll be 24 years until the next one, but we'll still be in a very high price situation when that drought comes along. It's just we've taken care of it other than that. Let's push the right button here. There we go. On the soybean side, a lot the same picture. The difference here is that while you projected year-end soybeans, corn stocks were the highest in 15 years, projected year-end bean stocks are the highest ever. So record high projected year world soybean stocks. We're sitting on a big crop in South America from everything I read. The projections coming out of Brazil this last week were a little bit mixed. Some were a little higher, some were lower than their previous one, but all of them were record high. Okay, so we got big crop coming there. We're going to have higher soybean acres in the United States this spring, more than likely, as the price relationship there really draws those marginal acres to beans. I'm pretty bearish about beans. I mean, I think we're going to have lower bean meal prices as we go into the end of the year. A lot of that depends on this year's crop. If you look at stocks to use ratio over here, which is the red line, among the highest ever. So when you start doing that, you start having to kind of scratch your head and go, $9.50, $10 beans. I don't know how that's going to last, given those kind of supply situations going forward. If we look at the wheat situation, kind of the same story. Record production, record consumption. Again, we've had pretty good wheat stocks over the years. And notice that, the stocks to use ratio on wheat, corn, beans, 10, 15%. You don't let wheat get that low. 35% is the stocks to use ratio for this year. It's been that high in 6 of the last 10 years. So this is a human food. You don't draw it down to only 15% of usage, and you've always got wheat being harvested somewhere in the year. So while we measure this on a U.S. crop year, we're right in the middle of somebody else's crop year when we measure that, and that's one of the reasons that the stocks to use ratio always looks pretty good. Let's look at the corn supply and utilization table from the last WSDA report. Again, USDA reduced the yield down to 171. They reduced the crop to 14.2. Still record large. That's the second record large crop in a row. But the carryout went down to 1.877, but that's still up over 50% from last year's projected carryout. And the stocks to use ratio at 13.8%, an important number. It suggests the adequacy of supplies at the end of the year. USDA's got the average farm price $335 to $380. We think that's pretty reasonable at this point. We think we could see some sell-off in cash corn and the futures as we go through the spring. Some of this corn starts to move, but not a great large one. If you look at the USDA midpoint of their price range and their stocks to use ratio relative to history, very close to the line that kind of represents the last 6 or 8 years in price versus supply. We think this price relationship could weaken just a bit just because of the value of ethanol is going to be lower because of gasoline prices. That might put a little bit of price pressure on this. We can see here usage, ethanol steady, just over 5 billion bushels of corn made into ethanol. That's about 14 billion, 14.4 on ethanol output. We think that that's going to be the number. Of course, 15 is the renewable fuel standard for this year. In actuality, 15 billion billion gallons of corn-based ethanol. EPA still hasn't announced what the actual number for last year is yet. So we don't really know where they're going to be on this requirement. Still, that's what the market is going to take. Now, lower gasoline prices are probably going to increase gasoline consumption and so create a little bit of space there for 10% ethanol blend. But we don't see that number growing substantially in the future. There are no new plants being built. The ones that are out there are up and running, and most of them are running full because they made all kinds of money in 2014. Their margins were excellent last year as corn prices fell. It's one of the real shocking things to the corn business is that ethanol plants like cheap corn too. They weren't supposed to do that. So anyway, if we go on to soybeans, by the way, I did want to point out one other thing on that chart. The line way up at the top is feed and residual plus the DDGS being produced by that amount of ethanol. Notice that corn-based feed ingredient supply is close to record large again. So another reason, and we think that's going to stay there except when we have very tight supplies in a drought year. We think that's going to be the reason we have much more predictable and lower costs of production going forward. Okay, soybeans, USDA increased the yield, increased the crop, left the carryout stocks alone at a time when analysts expected that carryout stock number to get lower, and thus the negative pressure you saw on beans and bean meal in the days following the January WSDA. Now, the important number here is 410 million bushels of carryout for this year, relative to 92 million bushels last year, which that 92 million might as well have been zero. I mean, it was basically no beans left over at the end of last year. We didn't realize, I don't think anybody had an idea of how long it would take and how difficult it would be to refill the pipeline here. And that's, I think, the reason you've had such strong soybean meal prices through the fall is that pipeline was completely empty and people were just kind of scrambling to try to get it refilled. It's kind of got there now. We can see a little bit of pressure on this as we go through the spring. Not any big breaks on the feed ingredient side. I guess if I was buying feed, I would hold off. I think we're going to get some lower prices, especially as the South American soybean harvest progresses. If I was selling soybeans, I'd probably get my 2015 beans sold, John. I think I'm pretty bearish about beans, and so I don't know if I'd be sitting out there. Corn, like I say, we'll see a lot of corn between 350 and 450 a bushel and that's going to be a weather market very soon anyway. So lower feed ingredient costs, bottom line of that is they're going to fuel expansion. I mean, it's one of the reasons that we're seeing all these species grow. It's very logical that they would do so. Fundamental long-term change, we caught up with ethanol. Growing oil and gas output will limit future ethanol growth, in my opinion, and yields continue to grow. The technology still is coming to bear to increase these yields. What does it mean for cost? This is our model based on the Iowa State University parameters. 2 years ago, $94 a hundredweight carcass was the average for the year. Last year it was $80. This year it's down to $71.58. That number has been as low as $69 and change last fall. My guess is it's going to creep down towards $70 as we go through the year here, and we're going to end up the year with costs near $70 on a carcass weight basis. Now, that's obviously good news for the bottom line as we go forward. Okay, let's shift and look at demand side. One of the variables that determines demand is consumer income levels. And of course, the performance of economies around the world tells us what those income levels are doing because they measure national income. And we put that together in regional measures of GDP. These are from Moody's Analytics for forecast for next year. They've got the world growth forecast at just over 3%, the set of columns on the left. North America, a little better than that. South America, a mixture, but a big recovery forecast for 2016. As we look at Europe, finally some life there, but still only about 1% growth. So if there's a continued sore spot in the world economy, it's Europe. Asia, they have growing at a little over 4.5%. Of course, that includes somewhat of a slowdown in China. One of the things that Moody's did not get in this, I didn't show the other slide of these things, was at the time they had the Japanese economy in recovery. I would think that Japan is clearly in another recession now. And so my guess is that they're probably going to dial back these growth rates for Asia a bit based on what's going on in Japan. For Oceania, again, about 2%, and world growth picking up to over 3% this coming year. The U.S. economy has clicked along pretty nicely the last 2 quarters for which we have data. 5% growth rates roughly on a quarter-to-quarter basis. That's the line on this chart. The bars here are year over year, and on that, we back up to about 2.6% growth. Now, that's nothing to write home about, and I commented yesterday that 2.6% is not going to get Janet Yellen doing cartwheels down Pennsylvania Avenue. Not that anyone would ever want to see that. But still, it's not a bad growth rate. And if the Fed could see this thing going at 2.5% to 3%, quarter after quarter, at low inflation rates, they would not be inclined to change very many things because that low inflation is important. If we see this pick up some, we think that there'll be some inflationary pressure. We don't think it's anywhere near there yet. And so I guess I'm not too worried about the economy at this point. The real important part for our business, I think, is in personal income growth. This is real personal disposable income. That's income after taxes per capita in the United States. We had a terrible year in 2013, 0 growth. Okay, that big spike in late 2012 was because of a change in the Social Security tax rate on January 1, 2013. So that was kind of a false thing, somewhat of a head fake, and that caused the big spike down at the end of 2013 because we were comparing to those good numbers. This year, though, we've run a pretty steady 1.5, 1.6, 1.7, jumped up to 2.2 in November. We're going to average the year in the high ones on personal disposable income growth. Again, that's nothing to write home about, but it's creeping back up to that average level that we saw back before the recession. And so people are going to have some more money to spend. That means that people feel better about the world they live in. These are measures of consumer confidence, one of them by the Conference Board, the other one done by the University of Michigan. Both of them are at the highest level since 2006 in their most recent observations in November. So some real growth there. You can see the unemployment rate tends to be very negatively correlated with these measures of consumer confidence. And what's interesting is it actually lags them. So when consumer confidence changes for the negative, it takes a while for the economy to feel that change in confidence and unemployment to start to grow. And the opposite is true too. We've got unemployment down, 5.8% or so. We doubt that you're going to see it go, There are people who said, well, it's going to go below 5. If it goes below 5, I think that's probably a bad thing. That would probably heat the economy up pretty quickly because you'd have labor shortages. There's a natural rate of unemployment out there, and it's a hotly debated topic among economists. I don't get into those arguments much, but I think it's a number in the upper 5s. I don't think you can go below 5 without really causing some inflationary pressure. If we look at the restaurant side, these things are getting reflected in restaurant trade. Much higher observations on the Restaurant Performance Index. In fact, again, the highest since back in 2006 and 7. On top of all of that, gasoline prices, of course, a big drop. I tell the story, and I just filled the pickup last night, so I got the numbers. Last summer, when I would fill the pickup, I got this used pickup a few years ago. I've always driven used pickups. I wouldn't know what to do to drive a pickup that didn't have rust on it. It just wouldn't be right. But I got this used Chevy pickup, and my daughter was driving it, and she came home and said, Dad, boy, that thing gets great gas mileage. I said, no, dear, that thing has a 34-gallon gas tank. So she learned a little bit about mathematics. And when I filled that thing for the last couple of years, the pump at the Casey store stopped at $100 before my pickup was full, which was not very happy camper. And I filled it last night for $57.60. Okay? So my daughter will be glad to spend that other $43, I'm sure. But still, that's the example of how many dollars of discretionary income are going to be out there because of these gasoline prices. It has mystified me how the press and the business press have talked about how negative lower oil prices have been for the world economy. There's about 5% of our population are in the energy business. There's about 95% of us in the energy consumption business. And it looks to me like lower oil and lower gasoline prices are going to be very stimulative to the economy. Now, gasoline prices play a big role here, but the top 4 importers of oil in the world are the United States, China, Japan, and India. You think oil prices might be a little stimulative to those economies, especially from the industrial side, with lower energy prices? I think this is a positive. And I've thought it from day one. Unless you own Shell stock or something like that, well, maybe then it's negative. I can tell you guys that those airlines are doing cartwheels. That's for sure, because fuel is a big deal for them. Okay, that brings us to taste and preferences, the black box of demand. And here we've seen some real changes. This was the cover article last July in Time magazine, and the title of it, if you can't read it, is Eat Butter. I saw this come out of the mailbox, and I skipped to the house. Look at this, I can eat butter. And the whole article was how we got it wrong on animal fats in the 70s and 80s, and the danger of those. Since then, we've had a lot of press about low-carb diets versus low-fat diets. We've had Nina Tycho's book, The Big Fat Surprise. It's become a bestseller. We've had LeBron James celebrated chiseling of his body in preparation for this NBA season on a low-carb diet. It would help if the Cavaliers would win a few games. Then a couple of weeks ago on Vox.com, one of their correspondents decided he was just going to go for 3 weeks on a diet of bacon and cream. And I thought, now there's a diet I could stay on. His doctor told him he was going to kill himself, and, there's just, going to wreck your health. He lost 12 pounds and his cholesterol went down 10 points. So, it was an interesting deal, a bit of a farce, but still, the point is attitudes are changing. And, I think it's really come to bear when we look at the amount of money that people have been willing to spend on meat in the last 2 or 3 years. We have now, supplies are obviously an issue here. But the reductions in beef and pork supplies over the last couple of years do not explain these kind of price increases. The only way this can happen is for demand to be extremely strong. And so that's the evidence of this. We have record beef prices. Those will wane a bit this year, but will not go down dramatically, in my opinion. We saw pork prices set a record in September. They've come down some since then. But, and actually more than I would have suspected, given the way retail prices are normally sticky downward, but still very close to record levels. Chicken prices close to record levels. When we put these all in a computation for real per capita expenditures for meats, add them together all across the 4 major species, this is what it looks like. Higher every month last year except for January, which was impacted by some very bad weather on the East Coast. We think December will be well above last year's level as well when we get those data. We have to wait until we get the import-export data on the first week of February to compute these. But a remarkable year. We look at pork in the upper left, led the way up 7.6% in 2014. It was up 5.5% in 2013. The Pork Board's goal of increasing real per capita expenditures by 10% between 2010 and 2014 is going to get blown away. It's going to go up about 15%. So a tremendous accomplishment there. Beef's in the two bottom ones. You can see that they've had a remarkable run the last 4 months. And they're up dramatically this year too. 6.5%. The left one is valued on with the all-choice beef, the choice beef price. The other one is if you value it with the all-fresh beef price, up 7.1%. If you go in the upper right-hand corner, though, there's chicken. And chicken hasn't benefited from this nearly the way the red meats have, which is logical given this point about fats and saturated fats. So an important thing going on here from a taste and preferences. Long-term, this is real per capita expenditures for pork in the upper left, beef in the upper right. That observation for pork in November was the highest since 1990. Okay, so it's been a long time coming to get back to this point. Beef is challenging its highs that were set during the Atkins diet 2004. Exports, a little different picture. Not nearly as good a year in 2014. Obviously, we've had problems with the Russians, but that's nothing new. We've also had a lot of problems with high prices and an appreciating dollar that's really worked against us. But one of the big factors was the fact that while the Russians weren't buying anything from us, they stopped buying it from the EU back in the spring due to African swine fever, which was kind of a smoke screen anyway. And that's 40,000 tons a month of product that had to find a home somewhere else, whether in Europe or some other export market. And a lot of it went to Asia. Japan, they were very competitive to Japan and China. They certainly did some damage to our business. And then I mentioned the much higher dollar, up about 20% since July, means that our product is more expensive to those customers buying it overseas. It's more expensive relative to our competitors. Our competitors' currencies are in the lower left-hand chart here. The green line is the Brazilian real. You can see it's devalued tremendously since 2011. But so is the Canadian dollar, the Australian dollar, and the euro in just recent months. And so all of their products have gotten less expensive relative to ours. On the right-hand side is our customers. The pink line is the yen. Of course, Japan is still our number one value market. That currency is devalued tremendously over the last 3 years, part of it intentionally by their government. You can see that the peso has lost a value just in the last few months, and so has the Korean won. The one that hasn't, of course, is the Chinese yuan, which is pegged to the dollar. I mean, they don't let it move, and so it's kind of stayed where it is. In fact, that currency is probably still well undervalued. It probably needs to appreciate more, but they're not going to allow that to happen anytime soon. Okay, brings us to competitors. The chicken business, we thought would be off and running in 2014. With lower costs and their short generation interval, we thought, man, we're going to get buried in chicken this year. And they tried. They really tried. They just had all kinds of trouble with productivity. They didn't have enough eggs to grow their breeder flock earlier in the year. You can see some very low growth rates back in the summer. They finally got up to, rousing 2% year-over-year growth in the breeder flock, which isn't very much, later in the year. That grandparent flock there had gotten very old. They'd cut back in 2012 due to a lot of canceled orders. They sold a lot of fertilized eggs to Mexico. So they just didn't have the productive capacity. We can see in the bottom here is the ratio of chicks placed to eggs set 3 weeks earlier. And you can see that late last year, that thing kind of fell apart. And it stayed bad all year. They had chick livability problems. They had chick hatchability problems, a number of things. Now, they're back to year earlier levels now, but that's because we're comparing them with the bad ones of last year. They put in enough hens to overcome that, and we can see broiler egg sets grew in the second half of the year. They've been up about 4.5% so far this year. Broiler chick placements are growing, so they're finally responding to these incentives. Last year, broiler slaughter unchanged from the year before. Broiler production up 1.2% was all. We thought it'd be 3 or 4. If you see down at the bottom, look what's happened to weights in the last 4 months. Back in about August, 5 months, back in about August, weights started growing dramatically. And guess what? I think they took a lesson from hog producers. We don't have as many animals, so let's make them big. In addition, this is a two-bird business. It's big boning birds and small parts birds. The small parts birds business hasn't grown much, but the big boning bird business is where it really grows, okay? That's where you get all the boneless, skinless chicken breast products and all those kinds of things. And so when the business starts growing, what does the average weight do? It goes up because the big birds are the ones that are growing. And we think that that's indicative of growth in that big bird sector starting late last year. So our expectations, growth. We think the 3 to 4% that they would have done last year is coming this year. They're solving those problems. They're aggressively expanding. Lower chicken prices. That 3 to 4% should get us, retail prices anywhere from 6 to 10% lower than a year ago. And that's going to make them much more competitive at the retail level for both retail and food service. So we think that that's going to be a bit of a drag on pork this next year. Now, the other story is beef. And this is really a story of incentives and resources. What you want to do in the beef business and what Mother Nature allows you to do is frequently two different things. We've wanted to expand this cow herd for some time, but in 2011 we had a huge drought in Texas and Oklahoma where 26-27% of the cows are usually located. In 2012 we had a much larger, not quite as severe drought, but it covered all the Midwest. It covered some pretty major cow-calf areas in the northern plains. And finally, in 2015, we've got pretty good conditions unless you live in California. So we've got some grass out there. We've got extreme incentives to grow the cow herd. Record profits for cow-calf operations last year and forecast for this year. So what's happened? Well, we're going to start to change these downtrend on cattle numbers. Now, don't expect them to go up to where they were, and don't expect them to go up very much for at least another 2 years. We'll have a cattle report next week that's going to indicate a substantial growth, 3-4%, maybe even more than that on heifers retained for breeding, for cows. That's the effort that's going on. Heifer slaughter was down 8% last year. So we're going to have more heifers laid back. But think about the timing here. Those heifers are going to have a calf this year. We'll get that calf weaned sometime in the fall or winter. They'll go to a feed yard sometime early next year, and we'll have some beef out of it sometime in late 2016 or early 2017. I mean, it takes a long time to get more product, and so it's going to be a while before we see much more. Record tight feeder cattle supplies last summer. They're going to stay that way this winter. We've seen continued very high feeder cattle costs, and so we think beef output is still going to fall in 2015 and another 2% or so, 1% in 16, before finally turning around in 2017 and going up. So beef availability is going to get tight. Their prices are going to stay high. Growth, in the meantime, as they grow, they're pulling those heifers out. And where you have 1-to-1 birth rates in the cattle business, you start pulling heifers, you have some real impacts on supplies. It's not like pulling a gilt out of every litter. It's a little bit different. High prices through 15 and 16. The recent sell-off in futures, we think, was mainly driven by funds unwinding some long positions. I stated earlier this week in something I wrote that the best explanation for the sell-off was the fact that the run-up was probably not warranted either. And so those markets tend to figure that out. Eventually, long-term impacts of very high prices. We got some opportunities to change buying habits here. I thought we had that last year. We would have had it not been for PEDV, but we have another shot at the apple here. We can change buying habits with some good marketing and selling pork directly against beef in the coming year. I suspect that the pork board is going to do that. I don't know if we'll see cook it like a steak again, but I sure hope so, because I think this is an opportunity. All right, brings us to pigs, which in the last year has pretty much been all PEDV all the time. That's been obviously the focus of most discussion, and rightfully so. It was the focus of a lot of trepidation as we went into this winter. A year ago this week, you'd be somewhere right there about where that yellow line was. We We're hearing reports of breaks all over the country and huge numbers of breaks in Iowa and Minnesota at the time. Over to the right is the most recent data, which was from week before last, and the total number of cases was 115. 118. It was 215 a year ago. The number of cases in Iowa had jumped pretty substantially up to about 50, but a year ago they were having 90, 93, 85 to 90 cases every week at the animal vet labs. Some of these in this run are monitoring. We don't think there's a decent portion of those that are not representing active outbreaks. We looked at the University of Minnesota data. They do a survey every week or have reporting from 19 production systems that hold 2.1 million sows, and they point out that's not a scientific sample, okay, or a random sample of any sort, but I point out that it's a darn big one, okay? 2.1 million out of 5.4 or 5, that's a pretty good chunk. So when they start saying they're not seeing any breaks in the sow farms on these large operations, I think it's significant. And they haven't seen very many. We had a big week 2 weeks ago of 4, okay? During November and December, as I note here, this year we had 12. Last year we had 85 of those farms that broke. Okay, they had about half of their sow herds that were positive. So these systems here have half of their sow herds that were still negative, still naive going into this year. And yet we're not seeing more of them break than this. We had estimated last spring, based on kind of number of sows that we were hearing that were breaking, the number of pigs they were losing in those breaks, that these would be the kind of reductions, the left-hand column, year over year in slaughter relative to a year earlier. Our numbers were very good for May, June, July, and August, and they've kind of fallen apart since then, which tells me that probably we got into, you get into a mentality of things are bad and we add too much to that, plus the fact that the PRRS was not nearly as severe last year as it has been in years past, and it doesn't look to be this year. Now, most of you and I have heard over the last couple of weeks that we've got some PRRS that is pretty hot in a few areas. We always have that kind of talk about the time of the Iowa Pork Congress, so it's not unusual. And the data from these operations say that we're running well below where the levels prior to 2013-14 would have suggested we are. Now, all of that wreaked havoc with USDA's Hogs and Pigs reports in the first half of last year. We kind of figured it would. The December report a year ago was pretty questionable because it didn't show any impacts in Oklahoma and Texas numbers, and we knew that there was bad things happening there. When the March report came out, most of us kind of scratched our head and said, oh, okay, now let's figure out what the real numbers are, and the same thing happened in June. But come along September, and the September report has proven to be pretty good. It was pretty accurate on most counts on the pig crop. I don't think we're going to see any big revisions of that September report as we go forward. The December report makes sense. They came out with a larger breeding herd than I had anticipated, but not by a lot. If you look at the right-hand column, that's the difference of the actual numbers from the pre-report estimates. Virtually all of them are positive, which would suggest this is a little bearish. But virtually all of them are less than 1%, which would say, well, that's pretty darn close. So we thought we'd get a little bearish reaction out of this report. We didn't. The first day, I think the market was down 30, 35 cents. The next day it was up. And so I have to say, and so far the slaughter numbers have supported this report pretty well. So it makes some sense, and it tells us that more pigs are on the way. I mean, the pig crop up 4%, farrowing intentions 3.9 and 3.2% over the next 2 quarters. Those fit with that breeding herd pretty well. We went back and looked at the historic farrowing rate of the December 1 breeding herd in the next 2 quarters, and that's the chart up the upper left. And as you can see, if anything, those 2015 observations might be a little low. We could get more litters out of this relative to history. Now, we know that there's been some kind of lagging farrowing rate impacts on some of these farms that dealt with PEDV, so I think these are probably pretty reasonable. On the litter size thing, the pig report doesn't give you really any basis to predict litter size. And so what I did was went back and looked at the relationship of the September-November litter size with Feb and March-May and said, okay, if the normal kind of relationship holds, what will the next 2 quarters litter size be? Well, that would be the red observations there. And if those hold relative to a year ago, they're up 6.8 and 4.7% from a year ago. Will that happen? That's a pretty good question right now. We had put in numbers 2/3 as large as that in our forecast. I have to tell you that everything I'm hearing about PEDV on sow farms would suggest that those litter size growth might be larger than what we have in our forecast at this point. And so we'll have to see how that plays out. But if you do the math of 3% more litters and 7% more pigs per litter, or 3.5% more litters and 5% more pigs per litter, you can see that the second half of 2015 is going to have a lot more hogs coming than what we saw last year. When we put these on a weekly basis, the green lines here are last year's actual slaughter. The red would be our forecast, and you can see the substantial growth in the second half. But also note that those numbers are very similar to where we were in 2013. Just a few 100,000 off on annual slaughter from the 2013 levels, so it kind of represents recovery back to where we were pre-PEDV. We have a few weeks in the fall of the year that are going to get very close to slaughter capacity, but I don't think that's going to be an issue of any significance for us this year. Okay, that doesn't mean next year won't be, but this year I think we're going to be okay on that. And again, so far the numbers have been pretty close to what we expected. Now, the surprise factor last year in this whole supply deal was weights. I knew they would go up. I was sure of that, but I really didn't have any inkling that they would go up as much as they did last summer. We had some weeks of 8 and 10% more than a year ago on weights, just huge pigs. And of course, a big part of that was cost, but the other part was that we lost some pigs and had lots of space in finishing buildings, so we could leave them in there longer. We think that's going to reverse itself here pretty quick. We've been running a couple of pounds above last year in the first few weeks of this year. That's going to stay probably for another month, 6 to 6 weeks. Then we think that the pig numbers are going to get large enough that we start crowding hogs up and we're going to have to move them earlier. So we've taken 1% off of production this year for a decline in weights relative to slaughter. Last year it ended up adding about 4%, got us within 2% for the year on production. This year it's going to take off probably about 1% from what we think is going to be close to a 5% gain in slaughter. Pork cutout values, if you love roller coasters, you loved last year because it was certainly up and down. But notice again, remember what I said a while ago, slaughter levels next year, this year, very much like 2013. We think you're going to see price patterns much like you see here for 2013. I wouldn't be surprised at all. We saw some decline earlier that year because of some problems with Russian exports, but the normal kind of seasonal price program would put us somewhere in the low 90s, low to mid 90s during the summer, maybe a little stronger than that on a few weeks. Right now, we're below a year ago. That shouldn't be a surprise. We've been up 5%. Last week, we're up 5.6% on production. And so we should say that, prices ought to be lower. What we're not foreseeing in any stretch this coming year is any kind of volatility like we saw last year, a much more normal kind of pattern. For futures markets, as of day before yesterday, had profits for this year at $10 per head. Just a week before, that number was $4.50 because we'd had some rally in hog prices into Tuesday. Of course, they sold off some. They're back up the limit today. I didn't run this model today. That number was as high as $30 a head back last October. Okay, and so we think that it's going to improve going through this year because we think the futures market is badly oversold. And so we suspect that the profits are going to be a bit better than this year. But still, the point to be made is even with what's on the futures market now, it's a profitable year for pork production. Okay? And there were years that we would have killed for $10 a head, right? So let's keep perspective and don't let 2014 completely skew your perspective of what's going on. Sow slaughter last year was well below year-ago levels for most of the summer. I think that was largely attributable. I think there might have been a little growth. There was some growth in the sow herd, but it was largely attributable to the value that positive immune sows had. So we didn't want to move those. We wanted to reduce the amount of movement going in and off of these farms. And notice, though, that sow slaughter caught up with year-ago levels late in the year, in November and December. I think a lot of our operations ended up with old sow herds. The parity level was too high. They started moving some older sows late in the year to try to get that pulled down. And there's some more gilts available out there relative to what it was last summer. Now, I think most of the gilts that are available are spoken for, but still, there are some more available as we've gone away from these PEPV breaks. The gilt slaughters percentage has kind of been all over the map, and I can't reconcile it very well with a 3.7% larger breeding herd. I do know this. On a couple of occasions, I've sat down with people that sold buildings and equipment, and they could write down 150,000 sows that were going in somewhere in the country. Now, have all of those been put in yet? I don't think so. So I think there's still some growth to come on the breeding herd as we go forward. Here's our forecast for slaughter. You can see this year we ended up, slaughter is going to end up 107 million head and change, down about 4.5% from a year ago. Notice the number for 2013, 112.124 million head. Our number for this year is 112.4. We've got 1% higher slaughter in the first quarter, 4.5 in the second, 7.5 in the third, 6.5 in the fourth. We're an average of 5 for the year. Again, we're taking 1% off of that to measure production. You can see the forecast from the other analysts here. I put them up for perspective and so that you can kind of see if there's differences of opinion. The only one that's significantly different is Livestock Marketing Information Center. I don't know if I don't know exactly what they did on litter sizes going forward, so that's the reason I don't know kind of where they are on their numbers, but they certainly are lower. I will point out that on the past year or so, they've been the best forecaster of the bunch, so I give credit where credit's due on supplies anyway. On prices, you can see that we look like cockeyed optimists relative to the futures market. Those numbers for the futures market would be about $3 better today than they were 2 days ago. But still, we've got hogs up into the lower to mid-90s for the second quarter, around $90 for the third quarter, dropping back into the high 70s for the fourth quarter. We still think that that's pretty reasonable. Now, our first quarter numbers are probably going to get revised downward just because we've just about got the whole month of January in at lower values than that, and so we might not be able to get into that range for the first quarter going forward. But 85 to 89 on costs. Remember that we're averaging 71 and change in that model, would still be a very, very good year for pork producers. Again, we have to remember that we're back to reality here. 2014 was an outlier. We don't, some people say, well, gee, we need to do something different because of what happened last year. I've been telling folks, I'm not sure I'd do anything different because of what happened last year other than try to keep your pigs healthy. Okay, risks. The number one risk to this business is always a major disruption of exports. 23% of our production going overseas. If we have something that blocks those exports any amount of time, we've got a real problem on our hands. The probability of that is small. The impact is huge. You have to lift it as the number one risk every time because of the magnitude of that impact. PED impact on pre-weaning mortality falls to near zero. I don't think it's going to zero, but I think this one is happening. I think it's probably less than what even we had put into our forecast, and so that might leave our forecast numbers for supplies a little low and prices a little high if this continues. And we're in late January. From a wintertime standpoint, I'm not sure there's a whole lot can go haywire on that thing from this point forward. Demand weakening, that given the role that demand has played the last 2 years, that's certainly a risk. We have to think that these preferences won't push real per capita expenditures up at that rate every year, okay? Those are real high numbers. So I think that this is going to come back. I don't think we're going to see negative numbers, but we probably won't see the kind of growth we've seen the last 2 years either. Exports, the world economy, awfully important, and exchange rates. I mean, a significantly higher dollar is going to work against us in exports, even though, I mean, we've gone through periods of high dollars before. This one's a little different than we've seen in the last 6 or 8 years because virtually every increase of the value of the dollar since even before the recession had something to do with a flight to safety. I mean, the Irish economy the Irish government starts to default on their bonds, and there's a flight to safety. The Greek economy goes through its latest bloodletting, and there's a flight to safety. And so, those have been kind of temporary. This one's probably more long-lasting, and most of the pain on these changes in exchange rate are exerted as the changes are being made. Over time, if you get to a new level and it stays relatively constant, you can adjust to that. How much expansion in pigs and chicken? USDA's got pretty sizable expansion. You saw what I put up there. We think the output on chicken is going to push 3 to 4%. I'm thinking it'll go toward the 4% number for this year before we get to the end of the year. So anything more than that would certainly be a negative risk. Packing capacity, not an issue this year. I pointed that out. But if you extrapolate this growth, some growth for another year, return to normal kinds of growth rates on litter sizes, which was 2% per year for a decade before PEDV came along, we could be in a bind in the fall of 2016. Now, in the interest of openness, I've been saying that for about 5 years. We were going to be in a bind in the fall of 2013, and the drought of 2012 solved that for us. We would have been in a bind this last fall, and PEDV solved that for us. It's going to happen. Now, we got a new plant coming, but it isn't going to help us by the fall of 16. The Michigan plant won't be up and running until 17, and so I think that plant will happen. I don't have any question about that. It's just not going to be here in time for the fourth quarter of 2016 when we normally run big numbers in the fourth quarter. So you need to think about that as you make your plans and you observe the plans of others. Finally, the USDA is working on updates to the dietary guidelines. I'm sure all of you checked the dietary guidelines before you had your breakfast this morning. They're not used by normal people, but they do serve as the buying guide for the government, for school lunches, for prisons, for lots of other things. And so they're important, and they've really got a thing for processed meats. And so a lot of our products fall in that category. And if they redo this with very negative restrictions on processed meats, it could be negative for our business. There's always some spillover, and so I think that's worth observing as we go forward. Questions?